Hi, I'm Klaus Vogt for Money and Markets TV. It's clear to me that the current US economic rebound is not a healthy and sustainable one. That's because it is the result of the largest monetary and fiscal stimulus program ever. For proof, just look at disposable income. A record 20% is derived from federal transfers, and these transfers are coming from a government that is already up to its eyeballs in red ink. The deficit has been rising since 2002, and it could hit a record $1.6 trillion this year, or 10.7% of GDP. But in spite of all the monetary and fiscal stimulus, the housing and labor markets are still in dire straits. According to the Case-Shiller Index, home prices are again in a free fall. They dropped an annualized 11% in December alone, and they have fallen for 5 straight months. As for the labor market, the picture is disturbingly weak. There are still 7.5 million fewer jobs than there were in 2007. Plus, the employment to population ratio just dropped to a new low for the cycle, lower than during the depth of the Great Recession. Housing and employment are two very important segments of the economy. Neither is participating in the current rebound. Meanwhile, budget deficits and transfer payments are at record highs. This paints a crystal clear picture of a dangerously unbalanced and vulnerable economy that's exposed to two major risks. Number one, soaring oil prices. With parts of the Middle East and North Africa in turmoil, crude oil prices have risen sharply. A $10 per barrel increase sucks $30 billion out of consumer pockets in additional gasoline costs. Oil prices jumped back above $100 per barrel today, and they have risen by more than $20 since November. But the current bull market started in March 2009. Historically, every time since 1985 that oil prices have run up this far, this fast, it has triggered or at least coincided with an economic recession. And since the economy is now so unbalanced and fragile, the risk is high that the same thing could happen this time. With the overall economy in so much danger, it's somewhat surprising that the S&P 500 is still near cyclical highs, despite recent declines caused by rising oil prices. But I'm now seeing an indication that the stock market may not hold up for long, which brings me to my second economic risk, lower money supply growth. The Federal Reserve's second round of quantitative easing last August helped boost money supply growth, but it's now dropping back again to levels last seen right before QE2 started. I see that decline as another major risk to the economy and the stock market. To protect your wealth from a potential economic setback and a market decline, you might consider an inverse ETF like the ProShares Short QQQ, ticker symbol PSQ. This fund's designed to move inversely to the NASDAQ 100 index. Right now, the NASDAQ has a price-earnings ratio of 24 and a dividend yield of a tiny 0.4%. In other words, extremely overvalued and definitely due for a pullback. Thanks so much for watching.